I think anyone's view of the success of the Jobs Act will be on how you measure success. If the measure of success of the Jobs Act is to be the number of jobs created, I'm skeptical that anyone will consider the Jobs Act to be successful. Obviously, this will be for the economists and other experts to decide several years down the road after all of the rules have been implemented and have had a chance to play out. But I have my doubts that it will have any significant impact on the number of people employed. But if we measure success of the Jobs Act by how much the provisions are used by issuers and whether it reduces the cost of capital raising, which amounts can then be reinvested in the business, which I suppose could include adding jobs, I do have some thoughts on that. I think it's interesting to note that 3 of the provisions of the Jobs Act, Title I dealing with emerging growth companies and Titles 5 and 6 dealing with the ability to defer when you had to register under the Exchange Act, did not require SEC rulemaking, and 3 have required rulemaking. And my outlook sort of varies depending on which bucket the title fits into. I think the 3 that did not require SEC rulemaking were taken advantage of almost immediately upon enactment. We all knew that they were coming, and there were some issuers, particularly with regard to some of the provisions of emerging growth companies, who did their first confidential submissions to the SEC within days of adoption of the Jobs Act. They were just waiting for the provision to be adopted so they could start using it. With regard to the provision that was adopted this week, I think it's a little too early. That just became effective this week, sorry. I think it's a little too early for us to know how that one's going to be viewed by the marketplace. But again, there are a lot of interest by people who wanted to know what they can do and what they can't do. And on the panel, we'll be discussing that in more detail. So that sort of leaves us then, I think, with the 3 titles that were not effective automatically and that were subject to SEC rulemaking. So we have the general ability to generally solicit. That provision just became effective this week, as I had said earlier. And you might wonder why it took the SEC so long. It's not like the SEC or the SEC's Division of Corporation Finance has nothing to do. The short answer is that they have limited resources, a lot of items on their plate, and therefore have to prioritize their activities. They still have to review the filings that get made with the SEC and assist companies in the public questions that issuers raise. Under Sarbanes-Oxley, the SEC is required to review the filings of every issuer at least once every 3 years. Registration statements still must be reviewed and declared effective. Interpretive questions must still be analyzed and answered. The SEC is still trying to finish its unfinished rulemakings from Dodd-Frank. It's involved in significant multi-agency projects involving derivatives and credit risk retention by securitizers of asset-backed securities. Those projects are viewed as significant in preventing a repeat of our last economic crisis and are both time-consuming and controversial. Some of the other Dodd-Frank provisions that require the SEC and the Division of Corporation Finance's attention for rules that haven't been adopted yet are the pay-for-performance provisions, which require each public company to provide information showing the relationship between executive compensation actually paid and the financial performance of the company. Another rulemaking from Dodd-Frank that still is pending is the internal pay comparison, which requires a public company to disclose the median of the annual total compensation to all employees of the company except the CEO, the annual total compensation of the CEO, and the ratio of those two numbers. That provision, and if you think about this, Dodd-Frank was adopted in 2010. That provision was just proposed by the SEC last week. The SEC is still required to do compensation clawbacks, which requires them to direct stock exchanges to prohibit the listing of securities of a company that doesn't develop and implement a policy with regard to clawing back incentive-based compensation where there's been a financial restatement. This one, the markets are sort of getting ahead of the SEC. It is becoming more common practice for companies to try to implement something with regard to clawback. So it'll be interesting to see when the SEC and the stock exchanges finally move on that one, where they are in relation to how market practice is developing. A couple of the other provisions the SEC was required to do by Dodd-Frank and it adopted. One is resource extraction, which requires disclosure of payments made to governments in connection with resource extraction activities. The SEC spent a lot of time on that rulemaking process, a lot of effort, and the rules were overturned by the court. It's gone back to the SEC, who's decided not to appeal that, but is going to probably do additional rule writing. And then there's conflict minerals, which requires disclosure of whether conflict minerals, as defined by the SEC, are necessary to the functionality or production of a product manufactured by that company. That was another controversial and lengthy rulemaking. Those rules were adopted. Those rules were upheld by the court, but they're now subject to an appeal. So the SEC spends a lot of time on its rulemaking that it already had on its plate before the Jobs Act, before it even is able to get to the Jobs Act. I think another thing going on at the SEC has been the turnover at the SEC. As an example, since the Jobs Act was enacted, the SEC has a new chair, 2 other new commissioners, and a new director of the Division of Corporation Finance. And the Division of Corporation Finance itself has 2 unfilled deputy director positions, as well as an unfilled chief counsel position. Inevitably, the change in leadership and the unfilled positions have slowed down the rulemaking process. And then besides those provisions that I've talked about, the SEC has other significant rulemaking that they're undertaking for a variety of reasons. One is reform of the money market fund industry, securities swaps regulation, which was also primarily mandated by Dodd-Frank, and some other matters. Another thing from the SEC front is that they've also generally received comment letters from the public seeking rulemaking. Some of the things that the SEC has gotten since the adoption of the Jobs Act are petitions for rulemaking covering things like alternative disclosures to existing disclosure requirements, amendments to Rule 10b5-1 governing insider trading plans, and the adoption of neutral Internet voting platforms. The staff attention has to be paid to all of these to all of these petitions for rulemaking and trying to decide how to proceed and whether or not it's something that they should put on their calendar. And I think added to the fact that all of this that's on the SEC's front is that all of their rulemakings lately seem to generate a lot of controversy, whether it's political, social, or other. There's many different constituencies that the SEC has to satisfy as part of their rulemakings. Before it proposes rulemakings, the SEC listens to many of these different constituencies and what they have to say, tries to take them into account when formulating its proposals. The SEC spends significant amount of time trying to reconcile various competing viewpoints, but it can't always be done. Think again back to the conflicts in the SEC's mission and the SEC trying to decide what it's going to do. And I think the final thing from the SEC perspective is litigation. If you practice in this area, and this is a relatively new phenomenon, is that the SEC has to be very cognizant of, but several of their recent rulemakings, as I've mentioned, have been subject to litigation and challenged in the courts. They've lost most of them, have won at least one. But this adds to the time it takes the SEC on the rulemaking front. Back when I was at the SEC, the fact that something might be challenged or sued, although you were aware of that, it was not something that you spent a lot of time trying to make sure you were trying to address as you were drafting and talking with people. Now I think they want to make sure they get it right from the procedural perspective. One final thing that maybe I'll talk about that is delaying, it is causing the SEC some heartburn that I think will cause them to go slow on some of these remaining provisions of the Jobs Act, is the possibility that certain of the changes made by the Jobs Act will increase fraudulent activity. I think so what they're trying to be cognizant of and trying to address is whether there needs to be some sort of increased monitoring and enforcement of market participants. So I think that participants who are trying to take advantage of some of the Jobs Act provision, particularly crowdfunding, and maybe even some of the activities in the general solicitation area, ought to be aware of the fact and should expect a heightened regulatory scrutiny of the practices that develop. So what is my outlook for these final three provisions? I think the good news is that, as we all know and as I've mentioned, in July the SEC adopted the general solicitation provisions from the Jobs Act and the bad actor provisions from Dodd-Frank, and they both became effective this week. Reflecting the controversy that even these seemingly straightforward to adopt provisions engendered, at the same time that they were adopted by the SEC proposed a number of changes to Reg D and Form D. Those changes would do things like require the filing of a Form D before an issuer engages in a general solicitation. They would require a final Form D at the end of an offering. They would require written submission materials to be submitted to the SEC for a short temporary period of 2 years. They would disqualify issuers from relying on Rule 506 if issuers didn't comply with certain requirements, including filing of a Form D in past offerings. They also would substantially expand the items that must be disclosed in a 4D. I think they are proposing to amend 8 of the items and add 6 or 7 new items. So what the SEC gave with one hand by adopting general solicitation, they're proposing to take back with the other. So I think that people who are proposing to do general solicitations, particularly if it's part of an ongoing offering that may last for an extended period of time, are going to want to monitor these proposed changes and consider them in deciding how they want to proceed with their offering. Which leaves me now with the outlook for 2 remaining Jobs Act provisions, crowdfunding and Reg A+. Crowdfunding was an interesting provision to follow as the Jobs Act proceeded through Congress. And some of the panelists, maybe Anne-Marie, when we get there, may have some interesting views on this provision or some of the other provisions. But as it was first drafted, it was extremely bare bones and looked like it could be easily used without much expense or compliance concerns. It didn't require SEC rulemaking to implement. It really seemed to just contemplate a person posting on the internet their idea for a product and seeking to sell shares of stock for some minimal amount per share. It didn't need regulatory action to implement, and the issuer really didn't need much in the line of advisors. It really was using Kickstarter to sell securities. What could go wrong with something like that? As you can expect, a number of concerns were raised, particularly by regulators and small investor advocates, with the lack of controls on the process and the fact that this would be a prime area for people to commit fraud and to steal from the small investor. In response to critics, Congress made a number of revisions to the crowdfunding provision, the result of which being that I am not hopeful that this provision will ever be widely used as a fundraising tool. First, the SEC needs action to propose and adopt rules. And we're not clear when the SEC might do this. It might be possible we'll see a proposal in the next several months based on recent history, but I don't expect that we're going to see a final rule in the near future. Second, a person using this process is going to need advisors to help them go through all of this. So if they can only raise $1 million and they have to pay for advisors, that's not going to leave a lot of money left to be able to use on further developing a product, taking their idea and trying to make it into something useful. Where I do think this provision will ultimately be useful is as a marketing type tool in building buzz about a company or about a product and maybe adding a little bit of equity in the company's capital structure. Think an internet company and what it does today. The company will raise substantial sums from a few large investors, but it will be able to use crowdfunding to generate buzz about either the company, the product that it has, the idea that it has, and will be able to use crowdfunding to raise small amounts of capital but get all of this information out there. I think this is really the type of company that can afford to take advantage of this provision. I hope that I'm wrong. I hope that the SEC makes this provision a little bit user-friendly, but I am not overly optimistic. And then there is Reg A+. As I said at the beginning, to me this is a sleeper provision of the Jobs Act and is really slipping under the radar screen. Issuers are going to be able to raise up to $50 million. The securities can be sold publicly and they won't be restricted. Because this is subject to SEC rulemaking, it's going to be interesting to see. We have not really seen much in the line of comment letters going to the SEC ahead of time, trying to like we have with some of the other provision, I think crowdfunding has generated in the thousands of pre-rulemaking comment letters. I think that Reg A Plus has about 20. Crowdfunding has people very, very strong, very specific points of view. Reg A Plus really doesn't. So maybe there will not be the loud outcry for the SEC to try to make this a very difficult process to be able to use. And I'm hopeful that people will be able to convince the SEC to try to make this a very useful provision and not take away any strong incentives to use this provision. With that, I think what I'm going to do is end the opening remarks so we can then, unless somebody has questions, but like I said, we'll also be sitting here on the panel and be able to take them then, and we'll look forward to them. But I thank you for the opportunity to sort of talk about my views of the impetus and the outlook for the Jobs Act. Thanks.